Okay, let's go. US Strategic Petroleum Reserve situation. Why oil futures are irrationally mispriced at this moment. Today, last few days, it's absurd. Here we go. Brent at about $96 when I'm making this. Hormuz remains closed. US and Iran still attacking each other. Israel still attacking Lebanon. And the market is pricing imminent resolution. I mean, parallel universe. I mean, seriously. 172 million barrels, the largest single country strategic SPR release in US history. Biden released 180 million barrels over 6 months in 2022. Trump has matched that in a matter of weeks. 400 million barrels globally, coordinated release by 32 nations, historically unprecedented. The market treats this as unlimited. It's not. 18 to 24% repayment premium. Every barrel is an exchange, not a gift. The US will be forced physical buyer later this decade to replenish at whatever price the market is trading then. Okay, so the US government has to pay back, has to replace every barrel to the strategic reserve. Core thesis to establish immediately, the SPR is masking the true depth of the supply crisis. Without it, the domestic drawdown would be visibly catastrophic already. America's emergency buffer. SPR releases currently are price suppression theatre, not structural supply relief. The SPR was created after the 1973 Arab oil embargo, specifically to prevent price shocks during geopolitical supply disruptions. It has now been depleted during the largest geopolitical supply disruption since its creation. That is the core paradox. 10% shed since the 28th of February. In 3 months, the pace is faster than 2022, and the starting inventory was already low after Biden's drawdowns. US commercial crude stocks erased all gains from the first 2 months of 2026 in just 5 weeks. SPR releases papering over a critical domestic shortage. The SPR was at these levels when it was still being built in the early 80s. Never this low during an active conflict of this scale. The exchange mechanism, the Department of Energy releases oil in exchange for repayment with premium, not stimulus alone. Creates forward buying pressure as repayment obligations fall due. SPR operational floor, early June 2026. After this, the release program stops. The last artificial break on key discovery is removed. Why $96 Brent is not an efficient market signal. 6 distinct mechanisms explain why $96 is wrong. It's a multi-failure price discovery, not one cause but compounding system failures. So algorithms execute in milliseconds on unverified signals. On the 27th of May, Iranian state TV claimed an unofficial draft deal existed. WTI fell 6% before the White House called it a complete fabrication. The price never recovered. This is Pavlovian conditioning at industrial scale. It's Iran state playing the White House game. Nothing to say Iran isn't playing in the futures market as well. Next, Iran's conditions include recognition of Tehran's authority over Hormuz. The US cannot accept sovereignty over an international waterway, they say, though it's not an international waterway, that's a lie. Each country has 12 kilometres, I believe. Anyway, that's as usual, Trump is lying. The Ayatollah cannot surrender it without a domestic political collapse, not negotiating positions, existential constraints, as with the nuclear system. The Ayatollah has clearly said those 2 points are not negotiable. Trump and his travelling clowns say exactly the opposite. Without those, they're out. Anyway, next. In thin overnight sessions, one large algorithmic sell on a ceasefire rumour moves the entire market. Physical crude buyers, who have actual skin in the game, are price takers, not price setters. Goldman Sachs published a $60 Brent average forecast for 2026 during an active Hormuz closure. Algorithms anchor to this, navigating with a map that no longer exists. OECD on land stocks fell 146 million barrels in April alone. The headline inventory data looks less alarming than it is precisely because the SPR releases are counted as supply. Keynes beauty contest. Traders price what other traders will do on the next headline. Every trader sells the ceasefire rumour because everyone else will. And they are correct, because everyone else does what everyone else did. Their collective action creates the very price move they are all anticipating. Or as they say, a self-fulfilling prophecy. Okay, the futures curve, paper versus physical. Okay, this will get a bit technical, but I think that's a good idea. Part of, Friar's education program, really. Okay, the futures curve exposes the market's internal contradiction most clearly. You see on the left, physical reality, on the right, the convergence thesis. Extreme backwardation. Front month prices significantly above deferred contracts. Means I need this oil now and will pay a premium, but I believe in 6 or 12 months it will be cheaper. $40 spread. WTI front month up $40 above December 2026 delivery. December contract is the market's verdict on the permanent price, mid-70s. Front is the crisis premium verdict. Dated Brent means that it's actually available. It's what the traders, what the people who actually want the oil now will pay. Dated means it's already been sent out for delivery. Okay, so this is where the spread is between what companies are actually paying on the day to get their Brent and what the futures market is saying the price is. Okay, dated Brent, $144.42 on the 7th of April. Physical delivery price was at the height of the crisis. Paper futures, $109 the same day, a $35 gap. The market literally broke in two. Rystad Energy says, strong backwardation throughout until beyond 2033. Specialist analysts believe the disruption is elongated. Yet the headline price is beaten down by these continual ceasefire rumours. I almost said rubbish. The convergence thesis. When the SPR floor is hit, the paper market loses its anchor to an artificial supply narrative. 246 million barrels drawn in 2 months must re-establish itself as the price signal. Chevron's CEO said, "Even when the strait reopens, it will take time. Physical supply changes don't respond immediately." The most commercially relevant voice on this topic. So the core message, in Friar's opinion, the $96 headline is the back end of the curve dragging the front down via sentiment narrative. Once the SPR can no longer do so, the front month must reprice to physical reality, in Friar's opinion. Physical reality. Inventory data the market is ignoring. We've got 4 IEA, International Energy Authority, data cards. They're not estimates, it's official inventory data. 129 million barrels in March, 4.3 million barrels per day for 30 days, equivalent to 4% of global daily demand extracted from existing stocks for an entire month. 117 million barrels in April, drawdown accelerated. Preliminary IEA data shows depletion rate not slowing. 5.7 million barrels per day on land rate. 170 million barrels on land in April. Oil on water actually rebounded. Tankers queuing outside Hormuz. On-land depletion is where refineries, consumers and manufacturers feel the pain. 146 million barrels from OECD on land. The developed world's oil buffer is collapsing. Direct consequences for diesel, jet fuel and naphtha prices regardless of crude. Okay, Chevron CEO back in March said oil future prices are still too low, well below the level warranted by the physical supply shortages facing Asia and spreading globally, which will take many months to replenish. That was in March. So Economics 101. Probably it would have been the first class of first year undergraduate economics class. I would teach demand and supply. The problem with the demand and supply model is that it's assumed there are rational actors, imperfect information, and instantaneous price adjustment. None holds here. We've got algorithmically driven irrational actors, deliberately manipulated information from both the US and Iranians. So I'm going to back up what I've been saying by using some academic papers to frame my thesis, as Charlie Munger has suggested. Okay, start the prospect theory by Canham and Tversky, 1979. Nobel Prize winning framework for how humans make decisions under uncertainty. People systematically overweight vivid, recent, emotionally salient events relative to slow-moving base rate reality. A ceasefire announcement is vivid. 170 million barrel monthly inventory drawdown is a statistic, boring. So the market reacts harder to the former. Market Microstructure by Carl, 1985. When noise traders, being algorithms chasing headlines, dominate volume over the informed traders, physical oil buyers who know their actual inventories, price discovery fails. The physical buyer in Singapore who cannot get a cargo is informationally correct but has no voice in the overnight futures session. The algos have the volume. And Keynes' Beauty Contest from the General Theory, 1936, Chapter 12. Professional investment is a newspaper beauty contest where you must pick not the prettiest face, but the face you think judges will pick, or what you think they think the judges will pick. Every trader sells the ceasefire rumour because they know every other trader will, and surprisingly, they're all correct. Okay, the convergence event, it's the conclusion here. 172 million barrels at 18 to 24% premium deferred debt. The US is not richer in energy, it is borrowing from its future energy security. 246 million barrels drawn in March, April. At this rate, the remaining SPR could be gone in the next few weeks if the conflict continues at the same intensity. The nuclear and Hormuz sovereignty deadlock. Trump cannot accept Iranian sovereignty over Hormuz. The Ayatollah cannot abandon the nuclear program and survive. Two immovable objects. Futures curve contradiction. The same market pricing $96 front month. Brent is simultaneously pricing Brent in the high 60s and 70s through to 2030. The two halves are contradicting each other. SPR operational floor. In the next couple of weeks, the market must price physical reality without an artificial dampener. Hormuz divergence model holds. Structural mispricing identified in the model has not resolved. It is, if anything, deeper than first identified.